Okay, good afternoon, everyone, and welcome. It is always an honor to see a full house here on a Thursday afternoon. My name is Lauren Nieves. I'm Head of Investor Relations here at Astor Realty Capital. Whether you're a long-time Astor investor or you recently joined the One Astor Income Fund or you're learning about Astor for the first time, thank you for being here. For those who are new to us, Astor Realty Capital is an institutionally backed private real estate firm investing across the capital stack in select US markets. Today, our portfolio represents approximately $3 billion in real estate assets, 39 investments, 22 exits, over 3,500 units, and 4.8 million square feet, supported by 65 years of collective executive experience. Since inception, our portfolio has generated a 20.2% average return to our investors. Tonight is especially exciting as we are introducing Crossroads Plaza, the second investment selected for the One Astor Income Fund. The fund was created to provide investors with diversified exposure across multiple assets, sponsors, and markets and investment structures, while the focus is on quarterly cash flow, strong risk-adjusted returns, and capital preservation. We are also pleased to share that just in the last couple of weeks, we have actually completed the fund's first investor distribution. This is a very exciting milestone and an early reflection of the income-producing strategy we have set out to execute. We believe that Crossroads is a strong addition to the fund because it combines existing cash flow with a clear opportunity to grow income over time. Tonight, Joe and our team will walk you through why this opportunity stood out to our investment committee, how the position is structured, and how it contributes to the fund's broader return and diversification strategy. Please, as always, use the Q&A and chat option below for a collaborative session. We want it to be informative and interactive, and we will address as many questions as possible before we conclude. So it is now my pleasure to introduce our host tonight, Joe Berko, our founder and CEO of Astor. Joe began his career in commercial real estate finance and investment banking in 1995 and has spent more than 30 years sourcing, structuring, and managing real estate investments. He founded Astor with a clear focus on disciplined underwriting, alignment of interests, and putting investor needs first. So based on that, Joe, I will turn it over to you.
Thank you very much, Laura, and great to see everyone here. I hope everybody's getting a good time during their summer. This is a unique opportunity that we're taking on. It's also part of a larger strategy that we have with the current sponsors team. We're very happy with their performance. We're happy to participate. There's going to be a small investment for us in comparison to other investments that we've done to date, but we feel that this will be a good start of what we consider to be a long-standing relationship. And so without further ado, it's 6:37. We'll try to wrap up in roughly 30 minutes from now. Let's put the presentation up, team. Okay, very great. And so if there's a way to open it all the way through, well, that'll be great. Excellent. Okay, so the Crossroads Center is an existing 154,000 square feet retail center in North Carolina. North Carolina is one of the leading markets in the United States, in particularly Raleigh, which is really taking Raleigh-Durham, which is really taking a lot of attention. A lot of industries are coming in, a lot of technology companies are coming in, and that sort of like flows over to the submarkets. This, in fact, is a submarket of Raleigh-Durham. The center is very well occupied. We'll talk about the tenancies. We'll talk about what we see here. And generally, we have a smaller position, as I said, only $2.5 million already. We have a good amount of interest from a number of our existing investors, both on the fund side and otherwise. Essentially, the center is 91% occupied with fairly low leases. These are leases that have started many years ago, some of them 10 years ago, some are even more than 10 years. and they're sort of like at the center, occupying space and what would be considered almost, in some instances, as much as half of what the actual current rent in the market is. There's not a lot that's being built in the area. We'll talk about pipeline, which is extremely small. I think it's less than 6,000 square feet of pipeline, so it's almost non-existent. There's a good amount of investment that's coming into the area. We've counted north of $900 million between various industries. Some of them are expansions of a very large hospital that's going to bring a lot of jobs, well, very, very high-paying jobs, as well as other industries that are expanding in the area. And so we feel that this is a very safe, a very risk-adjusted return type of a project, that we're going to take a preferred equity position. We're going 50-50 with the sponsors. Our positions will be that we'll get paid first. We're taking a 10.25% current pay along the year. It's a 3-year project. At the exit, we're expected to generate another 11%. To our investors, we're seeing anywhere somewhere in the vicinity of, call it 15 to as much as 16+% IRRs. And if you're more concerned about cash on cash, which I know I am, I care about how much cash my cash is generating. And we're talking about 15.5 to a little bit over 17% cash on cash at the exit. Sponsorship themselves have been around for about 15 years. They've done 36 multiple centers. One of them is just a few miles down the block from this particular one, which they've acquired over a year ago at, I'd say, 64-65% occupancy within a span of a year and a little bit over a year. They're able to stabilize the center to 100% occupancy. We're simply looking to do the exact same thing here. The major differences are, first of all, its size is a slightly larger center, 155,000 square feet. The other one's a little bit smaller, close to 120,000 square feet. The location of this one is considered main and main. It's in the major thoroughfare with heavy car traffic and visibility. So why do we like this investment? Essentially, the experience, the most important thing. We have a very experienced operator, 15 years in the investment space of buying centers, stabilizing centers, selling them for profit, 36 different transactions. This is a fairly good cash flowing asset. From day one, we're able to service the debt. We're able to actually generate income to you, the investors. Leases are 20 to 50% below what the market is currently. And we looked at the appraisal. The appraisal is very, very conservative. We'll talk more about this. But we're seeing 20 to as much as 50% markup on the existing leases, which means two things. The current tenants don't want to leave because they're paying extremely low rents, and every new tenant that actually comes in is going to increase the value of the center because people buy cash flow. This is a short-term investment. The current distribution that we're going to be doing is an 8.75%. That's the net to you after a management fee of 1.5%. And we're looking at 36 months, and minimum terms is 18 months. As always, we don't like to do anything less than 1.5 years. Fairly good risk-adjusted return, very easy to refinance the center. The game plan is to move the center from $1 million NOI today to about 1.4, 1.5, and then we'll probably not stick around that long, but then eventually the sponsor will sell it down the line and make a hefty profit for themselves, which makes us happy, which means we're getting paid. In terms of positions, we have 3 positions to our investors. That is the general positions that we have overall, not just in this particular deal, but how much capital you have under management with Astor. And I'm happy to say that we have a lot sitting in the Select, and we have quite a few sitting in Premier. So essentially the positions or the class of shares designed to be between the core class of shares, which is investors that have less than $1 million with us, 250, but less than $1 million, we generate for them a 15.3% IRR or a 15.5% cash on cash, where we take a 20% promote, and then our promote drops to 16% for the slightly higher category, over $1 million, but under $5 million, which a lot of you are sitting in that category, which we're happy to say. It's trust that's been building over the many years. Some of you have been with us 11, 12 years at this point. So under $5 million, we're looking at a 16% IRR and a 16.3 cash on cash. And for those that are in The premier category, those that have been with us maybe longer or maybe placed larger checks and so on, over $5 million, we're looking at an IRR of 16.7% and an average annual return cash on cash of 17.1%. Essentially, the deviation is fairly different. The management fee that we take 1.5 is standard. However, the promote drops from 20 to 16 to 12. In terms of the business plan, we're first of all, we're working with a very, very industrious group of individuals. One of the things that we like the most is that they have in-house leasing. They're very, very proactive. They send more than 10,000 emails on a monthly basis to tenants, potential tenants to come and join their leases, knock on doors, send flyers, make phone calls. They do everything active. They don't just rely on outside brokers. They're very, very active, which is extremely important for us. The leasing strategies, I think, are fairly well understood. Before closing, we're already negotiating 3 different LOIs. One of them is with a national tenant with, I think, almost 10,000 stores. This is going to be Dollar Tree. That's going to be occupying one of the spaces, the existing spaces, and that's going to increase the rent almost day one, almost overnight. But certainly in the first several months after, there's going to be some fit outs and things like this. The area, as I said, is enjoying a very strong inflow of new industries, new individuals. We are counting over 540 new employment positions that are going to open up in the next few years, and that's not counting the major one, which is an expansion of a hospital, which is going to bring, again, several hundred jobs. We still don't know the exact amount, but we're talking about several hundred jobs. Timeline essentially is to move the NOI, and most of it will happen during year one, move the NOI from 1 million to 1.47. They're not stopping there, but that's the point of inflection for us to say we're out. Essentially, we're looking at around a 3-year process time. I think maybe going to be a little bit shorter, but that's how we see it. Talking about the numbers, I'm going to hand over the baton to Andrew Milbank, who's going to talk about the financials.
Wonderful. Thank you, Joe. So here you'll see the sources and uses. So Astor's position, the $2.5 million of preferred equity there in the upper middle portion. We have a senior bank loan here. This is a long-standing relationship of the sponsor. He's done 3 other deals with him. So this is a strong local bank, very friendly with the sponsor, has done multiple deals. So there's a good operating relationship there. They're only at 64% loan to cost, so very reasonable leverage. We're at just under 82% loan to cost and under 70% loan to value. I'll also note that our combined, right, us, Astor and the senior loan are still less than the purchase price. So that's about an 8.5% cap rate on our position based on the in-place numbers today. So that's not including any of the more than $1.1 million that is budgeted for tenant improvements, leasing commissions, general property CapEx. So we feel that we're in a very good position here. Plus, we always like to be on at least a 1-to-1 ratio with our sponsor. So you have $2.5 million of our equity, $2.6 million of common equity from the sponsor to round out the capitalization. So we feel very good there. We do have a small current pay of 6 months that we have reserved. This allows the sponsor to make very good decisions with the leasing without having to worry about keeping our current pay going. So the property itself spits off enough income as is to service the senior loan and to pay our current pay coupon of 10.25%. But, right, talking with the sponsor in the event that he's able to say, look, I've got a great tenant, I've got a national tenant, they want to come in, but I've got to remove another tenant, I've got to spend 6 months doing CapEx for them. This is going to increase the value of the property by $1 million, or it's going to increase the income by $100,000, right? Very meaningful numbers. We're able to draw from this reserve to keep our current pay coupon going and not stress the overall property. So we think that's a very good point to have there. Joe, if you move to the next slide. Talking about the pro forma, there's just under $1 million of current in-place NOI, right? So at about $7 rent per foot blended across all of the tenants. The market here is at least $9.50 blended. We have several comps that are much higher than that, and our partner themselves, they already have the LOIs that Joe mentioned that they're negotiating are in the $15, $18, and even $20 per foot range. So we feel very good with the in-place rent roll and that those tenants are currently successful. The developer has his projection to get to about $9.50 a foot. We think that's very reasonable. We've increased, the expenses a little bit. We increased the vacancy a bit above what he's projecting. Just to stress the numbers a little bit, right? So the middle column there, right? Even though we're preferred equity, even though we're in a very safe position here, we have a fixed return. We like to go into a project knowing that our partner is going to be successful, right? We want to see that they are motivated to be successful. So on their plan, they're making fantastic returns, right? 39% per year returns on their common equity. When we stress the numbers, right? When we said we increased the vacancy, we increased the expenses, right? They're still seeing a 19% annualized return. And also on that number, they're still able to refinance the senior loan and refinance our position. So, numbers like this are what we love to see in a cash flowing investment. They make us feel good, and it makes us feel very confident in the position that we're in. A couple of the tenants here. I know this is probably very small on your screen, but it's a good mix of complementary tenants. You have some national tenants in there. You have restaurants and cafes and insurance, right? Like the things that draw people to a center like this. As Joe mentioned, we're going to be adding Dollar Tree, which is a national tenant. He's got LOIs for a clothing boutique as well as a restaurant in hand, and those again are at $15 to $18 per square foot. There are a number of tenants that have already indicated to them that they want to renew. So they're very, as Joe mentioned, very active on social media. They're very active on various leasing platforms. They have this team in-house, and they've reached out to a number of the tenants already. There's definitely excitement from those tenants to renew. The information is in the due diligence Dropbox, but there are 2 tenants that they've already gotten to renew. They have 2 additional tenants that they are in renewal discussions. Plus, as we mentioned, there's now 3 new leases that are pre-closing are already being looked at. So we're very happy to report on that, and it just shows the energy that they bring, the in-house leasing team that they bring. So Louis, that was one of your questions. I think that was I think I answered most of those as I was going, but if I didn't, happy to provide some additional information afterwards. If you go one more slide, Joe, probably 2 more slides. Is this the site plan? But a lot of upside in the rents as we've been discussing, anywhere from 20 to 50% across the board. We've got the inline tenants, the junior anchor, and the anchors, right? There's rent upside at every single level of the space. We imagine that the anchor tenants, despite them having the highest upside, those are going to be the ones that will be tougher to renew, right? They're anchors for a reason. We did not have a lot of increases in the pro forma from the anchors. It's really about strengthening the remaining tenants in there, right? The inline and junior anchor tenants, like a Dollar Tree, right? That are going to drive the NOI growth, and that because that's also going to drive the renewals from other tenants, right? Call it the mom and pop stores that are going to see increased occupancy and increased sales in their stores as you're bringing these other high traffic tenants to the property, which this is a main location in the area. There's a ton of traffic that's already here, and we expect that to continue to grow. You'll see the next
couple of things to note. This is really a snapshot, sort of like putting together all centers, all retail. There's about 7 million square feet. within the immediate area, putting together all retail, but not all retail, as we know, is sort of ventures according to averages. This is considered to be a much better center, and the reality is the inlines that's being negotiated right now, 3,000 square feet, is negotiated around $18. They might be getting higher, but we'll call it $18 for now. The average for the market is around 12. So, when you cluster together bed centers, off-location retail, off-location, and then you put it together, as if all of them are equal, we're looking at very nice upside potential. But essentially, specifically for the center, we're seeing much, much higher, both for the inlines. I think the anchors are actually running around $11 a square foot, and that's also a big increase from what the averages are. So just something to point out. According to the overall location, we're on the averages around 20%, just on the averages, 20% below, but we're seeing as much as 50% in some of those instances in terms of markup. Just wanted to point that out. We felt it was fair to show the overall market and the overall average, which is a very strong market, but it's good to point out. You want to continue, Andrew? On the right side, you have.
So you can see here a number of the comps that have been signed recently in the market. That very top property is actually the property that our sponsor owns in the market, and this is as he described it, a worse location than our property, right? So $15 a foot there. You can see here the average is well above the $7 blended in place, and also well above the $9.50 per square foot that we are projecting for the blend across the property. There's a bunch of information here on the market. Joe's kind of touched on it already. Joe, I don't know if you wanted to expand on it a bit. I think the key thing here, aside from the population growth, the job growth, the investment from a lot of large institutions in the area, like the University of North Carolina, the sales comps here are anywhere from 7.5% to 9%. Our position, right, the senior loan plus Astor's position is an 8.5 cap on existing income, right? Again, that's not including $1 million that's going to be spent for new tenants and for general CapEx, right? So as you're increasing that NOI, that's just continuing to improve our position. So in that worst case scenario, if we were not able to be refinanced out, right, we could force a sale of the property, and we think there's a very, very strong margin there to protect our position, which is why we want to be in that preferred equity position and why we think it's a good fit for the fund with a current pay component, right, 8.75% net to the investors throughout the hold period, followed by the accrual of over 11% gross, right, that is going to be paid at exit. For those that remember, the fund is 14.5% to 16% target net IRR. This deal is actually going to be performing just a bit better than that by about 0.5 point to 0.7% projected with a fixed return. So we're very happy to see that.
Very great. I was flipping very slowly through the pages, but please, if this is something that's interesting, we'll share this presentation, of course, the recording, and we'll also share the actual offering memorandum so you can take some time, review it, have some phone calls with us. It is worth noting that this is a deal that we're looking to finish fairly quickly. So we have a hard closing date. As I mentioned, there's already a good amount of interest from our investors, from some of you here on the call. On this property, and for obvious reasons, it represents very low adjusted risk in compared to, let's say, deals where we're going into construction or doing various different things. You can take a look at the Glassboro versus, the overall market as of snapshot as of middle of this year, April of this year. Vacancy is very, very low. There's almost no new construction. There's like 6,000 square feet of new construction of retail that's coming in. There's something called the invisible hand syndrome, and that's essentially the concept that rents are not far high enough so that it makes sense to build new. And so when you have a situation like this, you pretty much keep things as they are, fairly steady. If rents will start increasing significantly higher, and then we'll start seeing more construction and more of that will come along. But the inventory is pretty steady. There's almost no new things, and therefore we're seeing very high occupancy. And rent is continually the supply and demand, right? Rent is continuing to grow according to that. Overall, I mean, we have some of the sales comps here. It's worth noting that the cap rate that the sponsor is acquiring the property at 8.3% is somewhat in sort of like middle line with where things are. This is an asset that has a big upside potential, so I think he's buying it very, very well. The middle center here, he's bought it for 12.47%. It was a semi-distressed situation, almost semi-distressed situation. He picked up for a very, very great price. And as I said, at a very low occupancy with 122,000 square feet. Within 1 year, span of 1 year, he was able to fill it up to 100%. And so he's talking from experience. His team, his boots are on the ground. He knows the area, he knows the market. He knows how many more tenants are approaching the other center and how many he can actually bring over to this center. He's basically looking to duplicate this job here, which we like. We like it when people have experience at certain locations. They feel that that's their spot and they want to expand more. A little bit more about the sales comps you can find here, and a little bit about the sponsor. Essentially, Avi Malka and his team at Mafa and the rest of the guys, as I mentioned, they bring a good amount of real estate experience, good operation, lean operation, but a very good operation. But I think, as I mentioned earlier, the thing that really stood out to us is, first of all, they came very highly referred to us by our partners from overseas that have done business with them and highly recommended working together. It's a conversation that's been going on, I would say, probably for about a year and a half, give or take. We've been looking at some of their activities. We've been looking at some of their acquisitions. And we decided that this could be something that will be a fit for the fund. As I said, there's a larger strategy here. We'd like to do maybe multiple deals with them over the course of the next several years and act more of a lender. So in this particular case, we're coming as preferred equity. I think in future deals, we'll come in as the lender of the deal. We'll be the one with the first position and supply them with the capital needed for their CapEx, for the acquisitions, for all that good stuff. Of course, they'll bring their equity, and we'll continue moving with that. But yeah, as I said, they came very highly recommended. Folks that are our partners for many, many years have invested with them in the past, and we're very, very happy. As I said, the activity that they're showing us and the activity that they've done with our partners has definitely given us a very warm and fuzzy about these guys. You have a good amount of track record. They have some pretty nice IRRs. I wish we knew them even sooner. But they've done some pretty great transactions with some pretty nice exits that they've done for themselves. They have a very steady group of individuals that work with them, and they continue in such a way. So we're happy to participate. So all this information is available here. More about their portfolio, their assets. Their focus is to be very close to market centers, but be sort of like outside of it, right? Where there's less competition, where they don't have to compete with the institutional buyers and so on, and sort of like stepping into areas where they see a flow from major markets, major centers into sort of like the suburbs, and that's their expertise. I guess that brings us to the end of our presentation. So, if any questions, please, do a raise hand or simply type them here. I will take a couple of moments because we do have some new individuals with us and just touch on Astor as a whole. So Astor is now 11 going on 12 years since 2015, I'm sorry. The collective experience of our executives is now over 65 years. Our average across all strategies, right, between equity, preferred equity, and debt positions stands today at 20.2%. 16 top performing U.S. markets, 8 different states, 39 transactions to date with 22 exits. And I expect that by this year, this number will get closer to 24, maybe even 25. We're touching over $3 billion in overall real estate, over 3,700 units, $258 million from inception, and 4.8, almost reaching 5 million square feet. Beautiful real estate. This is based on Q3 of this year. Companies growing. We have pretty much, have associates all across the board from various locations, from Colorado to New Jersey. A good amount of folks in New York. Of course, we have a good presence here in South Florida, Texas, the Caribbeans, and other locations as well. Essentially, the focus has always been, the company's always been standing on 5 pillars: preservation of capital, ongoing asset management, which we feel is extremely important and missing from a lot of the investments that you are doing when you're doing it direct. We do offer above market returns. I think our structure is very, very fair, but we also choose from a huge pool of potential investments. Very, very few actually go through the screening, and then essentially there's a collective, we call the collective bargaining. We're able to come together, bring a larger check, and negotiate much better terms, which trickles down to better returns to you, the investors. And so the alignment of interest, we always make sure that the sponsors that we work with put real capital, we put our capital in, taking the exact same risk, just like everybody else. And for us, it is personal. Many of you here are personal friends, friends of friends, family members, and so on. And this sort of like the organic growth brought us to over 500 investors, including high net worth, ultra high net worth, family offices, and institutional investors that's been with us on multiple investments over the year. Some of the visuals here can talk about that a lot more, but you'll have it here for your viewing pleasures, if I will. And as I said, we are here. So anything that's anybody who's got more interest in us, of course, reach Laura, reach any one of our team, and let us know. We do need, so like if this is a deal that you like to do, and we have a little bit left, probably under $1 million at this point, I would say reach us very, very early. Okay, closing will happen by the 21st. Okay, the actual our closing is September, early September, but we need all capital to be in our account by the 21st. It's extremely important. I know it's a much shorter window than what we typically bring. Typically, there's more like 30 days, and we're a lot more relaxed. It's not the case here. So if this is for you, but the timing is not for you, that's also will be fair to say that maybe we'll skip this one and look at the next one together. I promise you that the investment number 3 for the fund and number 4 are in the works right now as we speak. That brings us to the end of the presentation. I want to thank everybody today for joining. We didn't mention Sebastian. Sebastian Lacayo is with us as well, instrumental member of our team. Thank you, Laura, Andrew, and everyone else who's joining us this afternoon. Looking forward to see you in this investment or the next. Take care, everyone.
Thank you, everyone. Speak soon.
Everybody.